Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show. I'm your host, Dan Breslin, and this is episode 117 with Ryan Wright on funding fix and flip deals. So about a year ago, I'm here in Chicago trying to sell a wholesale deal. As you probably already know, I buy and renovate about 15% of the deals that come through the Diamond Equity pipeline and wholesale the other 85%. It's usually for lack of solid contractors that we wholesale so many deals. But anyway, here's this buyer, and they're going to use hard money to close on the deal, or so they thought. The only reason we accepted their quote-unquote hard money financed offer on our quote-unquote cash offers accepted only wholesale deal is because they were using dohardmoney.com and claimed to have already closed 3 deals prior to ours with them. As you can imagine, they never closed the deal, so I ended up buying and renovating that one myself. No big deal. Well, today you'll get to hear Ryan Wright's side of that story. Since Ryan is the founder of dohardmoney.com, he is the best person to shed some light on that situation, which he does. And there's a big lesson here for agents, wholesalers, and investors on the proper use of hard money to fund deals, selecting the right deals to fund with hard money, and funding the rest of the deals either using your own cash or other private money sources. I'll let Ryan explain in detail shortly. And for anyone who's just getting started, looking for money to flip houses, maybe even a little guidance on doing that first right deal, listen closely and be ready to take notes. Ryan's philosophy in running his business is tailored to helping you complete those first few deals the right way, which means profitably. Ryan has been a resource for hundreds of first-time or first few times fix and flip investors across the U.S., as well as a low-cost source of funding for more experienced investors. So let's jump right in, shall we? All right, welcome to the show, Mr. Ryan Wright. How are you doing today?
Fantastic, Dan. How are you?
Doing good. So to give our listeners, we're in a lot of markets around the country. People are listening all over the country. I usually ask everybody who comes on the show. I am currently right now looking out over the lake here in Chicago, recording from Chicago. Whereabouts are you hailing from today?
Today I'm in Salt Lake City, Utah, looking at the beautiful Rocky Mountains.
Nice. I've never been. I imagine that vista is as breathtaking as the lakes and the oceans that I've kind of grew up and spent my life around, right?
I love it. I love both of them, but nothing like coming home.
Cool. So good place to start our jumping off. A lot of people may already recognize or even be customers of your company and know who you are and what you're about. But before we get into all of that, can you talk about your experience, how you got started in real estate before you ended up in the business you're in today, along with, kind of how the evolution and what your business today looks like, Ryan?
Yeah, absolutely, Dan. Right now, I am the CEO of dohardmoney.com. What we do is we provide tools, resources, software, and capital for fix and flip real estate investors primarily. We help anywhere from the new guy just getting started up to experienced guys that are looking to scale and offer resources. My story is kind of interesting because you never know where you're going to end up. I tell people all the time, look at every door as a new opportunity and see where it can take you. And so I started out as a traditional real estate agent, Dan, and from there I helped regular buyers and sellers, and then got into doing some rental properties, and from there got into doing some flipping, and from there recognized the need for capital that was reliable and consistent, and got into the money side, and then that's kind of scaled into some software and a few things. So anyway, I've gone the rounds. I came from the investor side into money and into the software and tools rather than coming from the opposite way. So I've got a unique perspective on it.
Nice. Sounds good. So you, I assume Salt Lake City is your home, correct?
My hometown, yep.
Would you mind, before we dive into some of the funding and things like that, what was the real estate experience like? Is Salt Lake City, Utah, is that a hot market? Is that a growing market? Is that a stable market? Tell me a little bit about, the background of the city that you cut your teeth as an investor.
Yeah, absolutely. I got started back in 2000, 2002, so it's been quite a while. Back then, there was quite a bit of opportunity here. So you could find a good deal on the MLS even if you searched hard enough, made a lot of offers. And so, it was quite a bit easier to find properties, less competition. And it took me a while before I learned direct marketing techniques because I didn't really need it. So I started with that. It was a stable market. It has gone up tremendously right now. Utah is just going crazy, specifically in the Salt Lake area with values and appreciation, that type of stuff. So right now it's a really stable market. Interestingly enough, we actually don't offer capital here. I've got some holdings, some real estate holdings and a few other things, but with some regulatory issues after 2008, we're not funding here, funny enough. So anyway, that makes an interesting dynamic.
That's cool. Is there a lot of new construction going on in Salt Lake?
Quite a bit. Inventories are down substantially. They just can't get houses up fast enough. I put a property on the market on Friday, and I think we had 5 showings that afternoon and 7 the next day and 5. And by Monday we had an offer, and Tuesday we had another offer. So, there's really a lot of activity. There's just a lot of demand, and supply is pretty low right now.
Yeah, we're really at a blessed place to be right now, Ryan. It's the end of August 2018. Overall, all the numbers and the economics of the United States are strong. The stock market is, at record highs. We just broke the record for the longest running bull market, I think, ever in history. And a lot of people are waiting for the sky to fall. And there's like some of the rhetoric I'm sure you and everybody else listening to the show hears of, the sky's falling. It's going to be a great time to buy. It's going to cycle down. And a couple things from my perspective, I don't see a coming cliff ever in my lifetime again, and I could be wrong and totally eat my words, but the underwriting time bomb, the underwriting catastrophe that took place, the perfect storm in the financial markets that took place in the 2000 to 2007. I got into business in 2006, so I had to, get my face pummeled into the dirt before I learned the direct marketing and how to actually do deals on a consistent basis and build deal flow myself. But, the once in a lifetime buying opportunity that took place in 08, 09, 2010, 11, when all the hedge funds and everybody kind of got into the business before the numbers started rolling back with appreciation and the values started climbing like we have today. I just don't see that coming again. But one of the things I notice often, because I'm in a lot of different markets. I'm in Miami, I'm in Tampa, I'm in Atlanta, I'm in Chicago, I'm in Philadelphia, and each of those markets has a varying degree of heat, a varying degree of things like new construction starts. And I know that I remember in 2006, 7, and 8, there were a lot more comps when I would look at a raw land deal, Ryan. There were a lot more comps showing up, even when you pulled a regular MLS comp search to fund a fix and flip deal in neighborhoods where, normally new construction would not be taking place. Obviously, it takes place in, $500,000 and up type of neighborhoods anyway. Even when there's a downturn, there's somebody you can find somewhere building some custom new construction home at the higher price points like that. But in these neighborhoods where I'm talking about, there's new construction selling for around $200,000. It was crazy. There was like multiple new construction comps. It's very rare that I see any of that yet, which to me is another indicator of that the market is still stable and not overheated and overpriced. And that was why I asked about the new construction in Salt Lake. You tell me that the market's kind of overpriced by telling me that, the inventories are so low, you got multiple offers. It's very difficult to find, opportunities to buy in Salt Lake. And you tell me there's a lot of new construction. I think, okay, well, there's a much hotter market than I'm used to dealing in the deals I look at on a regular basis. Do you kind of have the same observation? What would be your opinion on what's taking place out here in the market if you had to guess?
Yeah, absolutely. I appreciate the opportunity to. I mean, I'm with you. There's two things I kind of look at. I look at sub FHA properties and over FHA limits. Basically, what will FHA allow or guarantee the loan for, or provide insurance, I should probably say. And that varies by area. You can look up FHA loan limits, Google it, and you can find it for your area. But I separate properties under that, sub FHA and above FHA. So in my area, the properties that we're selling, the $1 million properties or the $2 million properties, they have not recovered in my area. So for example, there's a $2 million property, $1.5 million that ended up selling for $500,000. That property today is probably worth about $850,000. So that stuff has not recovered. The sub FHA properties have recovered and are now worth more than they were, in the 2008 or 2007 pricing. So we've seen that segment increase. I'm kind of in the same perspective with you as with the overall marketplace, where I think the market is pretty strong. Yes, I think there can be some corrections that will happen, but I don't think it's anywhere near the corrections we're talking with 2008 levels whatsoever. So yeah, I think there's going to be that. And I think it's regionalized. I mean, we've got some areas of the country or even some areas of counties where it's like, hey, this area is just struggling for this or that. The values aren't as good. But and we're in a lot of states. We operate in 34 different states. And so we've got pretty good idea. I'll say this, real estate is localized. And secondly, there's always an opportunity. In 2008, there was opportunities. As a matter of fact, a lot of our financial investors that help and bring capital and those things to us after 2008 were so happy with what we were able to do versus what they had in their other investments. They had so much more confidence and brought even more capital to us to deploy because of that experience. And so it's kind of one of those things. It was painful. It was painful. Yeah. But it's one of those things as part of the growth and part of, our model and those things. And there's always an opportunity. You just have to be looking for it.
Yeah, you're right about that. I think we see a lot of the same, with the exception of the downtown superheated, areas. We do have some growth and some $1 million plus properties starting to sell, like in downtown Chicago as an example. But overall, the observation's been the same that you just mentioned, that the above FHA is a great statistic to pay attention to and a way to separate out the market. We have, I'm sure you'd agree, most people would, the millennials are starting to buy houses. They're in the age of buying the sub FHA property. And so it would make sense just from a demographic point of view in our country that we would see the largest population of, house buying people are interested in starter homes in that sub FHA price point. Maybe 8, 10, 12 years when we get to the move up years for the millennial segment, maybe that $1 million price point starts to kind of take off like a rocket ship, sort of like that same price point did in the 2000 to 2006-ish era when they built a lot of that large home inventory to kind of satisfy the demand of the millennials' parents, the baby boomers who are reaching that move-up age. So, that said, I'm going to switch gears just a bit here. What markets do you, Ryan Wright, you've been in there, you were loaning money, and maybe you had to get out of that market for some reason? Is there any market that you had to pull out of because of some reason, and what would that reason be?
So we haven't for a long time. We had to pull out of a market, and I can't remember which state that it was. One of the biggest reasons for us in marketplaces is dealing with foreclosure time frames if we get into a problem, eviction time frames if it takes forever to get a tenant out there. Let's say we do a loan, somebody puts a tenant in, even though they're not supposed to, even though the docs say they can't, that can run some problems for us. And then taxes. So those are really the three big things for us: is foreclosure time frame, eviction time frame, and property tax percentages. I know there in Chicago, taxes are super expensive. In Illinois. And so we do deals there, but that's one of the things that is always a headache, is the how expensive taxes are there. So that would be the reason we pulled out. It's been 5 years, 3 years, I want to say, since we pulled out. There was one state we went into. I'll give you another example. There's another state that we had some legal challenges with. It was Florida, actually. It's one of the most popular states right now. And, we had a few challenges there from our legal team with, usury and types of loans and that type of stuff. So we tiptoed into there and tiptoed out. We're still working on that because there's a lot of different things that come around the business that we're in. So, but mostly it would be because of foreclosure timeframes. We also have done area specific. So like down in Texas, when we've got like Harvey that hits, we'll put a temporary freeze on things, or like the Baltimore, Maryland riots. We were looking at a property right across the street from where you could see I think it was a Walgreens where the car was on fire and it was like rolling on the news all the time. And I had a property around the corner we were looking at. So, there's going to be temporary restraints, as those situational things happen. But as a matter of, it's really, legal concerns, or it's foreclosure time frame, eviction time frame, or how freaking expensive the taxes are.
Well said. I asked because I had a lender, I won't mention the name or anything, but they did pull out of Illinois. They said their default rate went through the roof. I guess they had one or two bad borrowers. I don't know all the details. Maybe it was some of the same foreclosure, eviction timelines, et cetera. But always curious as to what makes a market not tick, for the simple fact that I've gone in, failed in a few markets, or gone in and stayed in a few more markets, and that's always just always something on my mind personally. So, Ryan, let's talk about the ideal situation. So when I fix and flip a property, we're doing a little bit of volume here. So I have a network of private investors. I have the podcast. A lot of audience members reach out directly, fund my deals, 2 points, 10% interest while I have the money. It's a good return for people, as I'm sure that your investors get a good return from your company. But for someone who's listening who doesn't have the luxury of 5 or 10 years worth of experience, or maybe you need a year or two worth of experience, what would be the, function? Who would be the ideal client who, if they're listening right now, they would raise their hand and say, oh yeah, you know what? Do hard money, getting this hard money loan. This would allow me either a step in the business or a step to scale my business up. Like, what would that customer avatar look like for you?
Yeah, great question. I kind of put people into two buckets. You've got the bucket of people that have, 10% down, have good credit, and have experience. And so if you've got those things, if you've done a flip in the last year or last 2 years, if you've got 10, which really turns into 20% down with closing costs and those types of things, and you've got decent credit, there's a lot of loan options out there for you. And we have those as well. But there's a lot out there, and there's lots of options for you. If you don't have good credit, if you don't have experience, if you don't have money, we have a very unique program that we can work with people with little to no money, without a lot of experience, without great credit scores. And so we help the newer investor get started, which is a challenge. Both from our side and from their side, but we are really passionate about seeing, a guy, we had a 19-year-old girl that did her first flip, and, she just graduated from college, or 18-year-old girl that did her first flip and just graduated from high school. And that's exciting to see. And so we get really jazzed around that. It used to be for us, our phone, this was prior to 2008. Our phone rang off the hook so much with people saying, I want to get a loan. Will you fund me? And we'd say, hey, we are really a hard money lender. We lend based upon the asset. We kind of think of ourselves as the last of the hard money lenders. And so our phone would ring off the hook and we'd say, yes, we will, as long as the deal meets these criteria. These are the criteria we look for. And it got to the point where our phone rang so much we had to disconnect our phone. And it said, hey, if you want a loan, go to our website, do an application. And then we built a little computer system that would give them a red light or green light. And then we would then call them if it met these criteria, because our phone, we couldn't help it. And then after 2008 happened, we were doing a SWOT analysis, strengths, weaknesses, trends, threats, and really said one of our biggest assets is our phone rings off the hook. And what we came to realize is the people calling us, they wanted money, but what they needed was a system. They needed help. They needed what it would take to get that first deal done. And that's really evolved into us providing all kinds of different services. So I think the ideal person for us is someone that's a go-getter, somebody that's willing to go do the hard work, and somebody that's willing to go make some things happen, understands there's going to be bumps in the road, and knows how to roll with those, but is committed to the process. I think someone with a commitment level, somebody that has a little bit of time that they're willing to work I would never say quit your job or any of those things. Keep it. Let's, get you going. Let's do it. I think the first deal is the hardest. And I look at everybody we help get their first deal done as like a trophy to put on the wall, and remember forever.
Yeah, well said. I think that flipping properties, I always wanted to flip houses. When I was like a little kid, my dad did a couple rental properties, and we were in there sanding the drywall and, helping him out. I was probably 12 years old, and it was always a dream of mine. Oh, I'm going to flip houses someday. And I'd be 19, 20 years old and, talking about it with people, and never really, I guess, the right people were at the right time, because it took me until I was 26 until I finally got in the business and then discovered like the real truth that the most important thing that you can get your hands on, yes, you need the money to close the deal, but even more important, and like, the chicken and the egg, you need the deal and the money. I'm of the strong belief, and I know a lot of people would probably agree, that you need the deal first. If you have a high quality, good deal and you figured out that end of it, you can get the money. And so once I figured that out, I was in the business. And flipping properties, somebody can go out in many markets. I know there's probably a few markets where it's not possible, but once you kind of get your legs under you, you could do 2, 3, 4 flips a year. You could do that exclusively, and you could make, $100,000 give or take per year doing that, with probably relatively low stress. I know, like for myself, it was never 4. I got in and I needed to do like many deals. And I'm sure that most people listening are saying the same thing. No, I don't want to stop at 4. I don't want this comfortable thing. I just want to kind of keep going. And to get in and do 3 or 4 flips a year. I mean, am I off base there and thinking that would be like a good goal for somebody getting in the business? Do you have clients like that who, full-time job, and maybe they get to a certain number of deals they do per year, and that's ideal? Like, what would be a good target for the 18-year-old girl who flipped that house? Should she try to do, 25, 30, 40, 50 deals next year? Or is there like a magic number you see from the lender's perspective where they're not getting in trouble, biting off too much that they can't chew, but also hedging themselves against, if you take a loss on a project or something like that?
Yeah, it's a great question. It really depends on what the goals are. I mean, I think that HGTV and I'm picking on them, but those types of shows that are out there really glamorize, like, by the time, I start eating dinner, I'm watching HGTV. By the time I finish, my entree, the house is renovated. By the time I have a scoop of ice cream, they've already made $25,000, and it happened in 18 minutes and 32 seconds. And I think that the excitement around flipping has glamorized it, and it's done a little bit of a disservice, because although they'll show like a stressful moment, it's really glamorized. And it's not the real stress or the real concerns or the real problems that happen. I think it's made it look too easy. I think the best ideal for most people most people aren't made, designed, or bred to become, crazy house flippers and doing tons of deals. Most people, I think they could literally change their financial future by doing a flip a year. An extra 20 grand or 30 grand, depending upon the market, and you did one a year, that could change your future. You could pay off your house in a few years doing that. I like your concept of saying, hey, let's do a handful of them, maybe do a flip every single quarter. We don't like a borrower to have more than 3 deals with us at any given time. That's kind of one of the things that we look for. But I can tell you, I've had builders that got out of building new homes and got into flipping, and we got into them with 3 deals, and it was too much for them to juggle, and they couldn't keep up with it, and they lost the quality that they were doing. Most builders don't do a good job about finishing. They do a good job with 80% of the work, and 20% of the work they don't know how to get the finishings done. So I've had situations with that. I've had situations with experienced investors that did good for a while but let their foot off the pedal. There's also situational, like life happens. Somebody goes through a difficult situation and it changes them, and they've got to step out of the business, or we get into a situation. I mean, the number one thing, when we're working with a new investor, and because we're willing to lend more money, a higher amount than most places will, we're conservative. And that's the big thing. So if you've got money and you've got experience and you've got great credit and some track record, a lender can be willing to take on more risk. because they feel like it's less risk because they're actually using your qualifications, kind of like you went at the bank to get a loan on a house to live in. They're looking at your resume, your track record, your bank account, some of those things. And so they're kind of, it's not really a hard money loan, although it is because there's less qualifications. But a lot of these hedge funds and those things are turning around and packaging and selling some paper out to Wall Street to recapitalize. And so they want certain things. So they're really, we think of, a hard money lender is really saying, I'm going to lend on the asset, and that's all that matters is the asset. And we really hope that you'll come through and do these things. And so that's kind of one of our things is being more asset based driven. Being that the difference between people say, what's hard money? Hard money is lending on the tangible asset. There's soft assets and there's hard assets. Soft assets is my job and my skill set and, those types of things. The hard asset is what that collateral is being tied to. So it's not hard because it's hard to get. It's actually pretty easy to get. It's hard because the underwriting criteria, we're looking at the hard asset in making our determinations if it's something that we can lend on.
Yeah, and that's ironic. You mentioned the issue that builder had, a few years or whenever that took place, and the 3 deals was too much. And it's interesting. I'm looking over my own career flipping houses. I'm 12 years in the business now. And I think it was really important for me. I grew up on the job site. So my dad had me pulling electrical wire on new construction back in the 90s. Pouring concrete sidewalks right around that age of 12, 13 years old, working summers, construction. So I had not a mastery level of working on and flipping houses, but I kind of had enough knowledge where I could figure out how to do stuff that I needed to do. And I could do almost all of the construction project myself with my own hands. And if anyone's listening and says, oh, me too, don't do it all because it's going to take way too long. You're better off learning how it's a more valuable skill to parcel that out. But, where I'm going with it is there's at least that basis of knowing how tile was set, setting tile myself, going through the process of the details of making sure that all the grout lines were perfect, going through the detail of painting trim and putting door handles on and taking off hinges before I paint. It sounds like a bunch of, small little inconsequential detail. But, having done all those things myself, I can observe when I have a high quality contractor on the line. Not only that, when I walk my own projects or if one of my partners is, at this point, they'll FaceTime me at a project in Atlanta. I'm not going to hop on the plane and check out the Atlanta deal, but I'm looking through my lens of every detail that's happening on the project. And this is not a cookie cutter thing. The house in Atlanta is a completely different project than my house in or condo townhouse in Chicago that I'm flipping. And I can't count on always my contractors have that attention to detail and getting things done. So that last 20% that builder was lacking in, 80%, they're good at the first 80%, but the last 20% in finishing. I mean, there's a lot of houses that I buy, Ryan, and all I have to do is the last 20%. I'm going in there and I'm cleaning the place. Yeah. I'm changing the blinds. Yeah. I'm putting some carpet. I'm putting a new cabinet handles in. I'm doing all these little detail things to prepare it for market. And then I'm selling it and making a fair profit. That seller was they didn't even have the awareness to look around, let alone the money and the skill set to maybe do that stuff. So, the finishing, that soft asset and the skill of attention to detail is something for any flippers to just make sure we're paying attention to that stuff. Make sure we're getting that part of the job done.
Well, and I think the 80-20 rule applies anywhere, right? I mean, the reality is I think a lot of potential real estate investors give up way before they give it a good enough chance. I think they get met with resistance or a bump in the road and they give up on it. And the reality is it's 20% of the people make the world go round. And it's those same 20%. The same 20% have 80% of the wealth, those types of things. And I don't want to get too theological here, but the reality is the guys that commit, that put a plan together, that follow the plan, that find their way around obstacles, that take ownership for the outcome. I really believe the best real estate investors are the best problem solvers. It's simply, what's the problem? Let's find a good solution to it. Let's move on. So I'm a big believer in hustle, and I'm a big believer in problem solving. And I think that gets you a long ways, not just in real estate investing, but also in life.
True enough. We solve a lot of problems, and I think, like me, I'm guilty of thinking when people said, oh, you got to be a good problem solver in real estate if you want to be successful. And as you and I are having this conversation now, I always had this definition of, well, I solve problems like if somebody's behind on their mortgage, I'm showing up the day before the sale, we're making a deal, I'm wiring money, I'm stopping a mortgage foreclosure, I'm helping them out with the hoarder house, I'm helping people get moving trucks, and we're solving a lot of problems for the seller. But the light bulb went off just now as you were speaking, Ryan, and I'm thinking, oh, there were a whole lot of times when I showed up on, our renovation project and there's some, issue with the leveling of the floor, and it's me solving that problem that allows the contractor to move on to the next step, times however many, the renovation, literally the hands-on nuts and bolts problem solving of all the decisions that are made during the course of the rehab project. Cool. I'm going to switch gears.
Master problem solver. That's the title.
Cool. I am going to switch gears just a little bit here. So we do a lot of wholesale properties at Diamond Equity Investments. I think there is around, give or take, 80 deals on the board for the 5 markets right now. Some of them are under contract. We're waiting for title. Some will fall off because title won't be clearable. Some of those properties are sold, waiting to settle as wholesale deals. A percentage, maybe about 10% of those deals are either in the process of being funded to do a renovation project, or under construction right now, or wrapping up construction and maybe on the MLS, but not sold, waiting to settle yet. So because of the wholesaling, I just want to talk a few minutes here. We here at Diamond Equity Investments have run into people who have closed 2-3 loans with dohardmoney.com. It's not just hard money with your company, so it's no reflection at all on you, but more hard money deals in general, and the challenges that are posed for people who are trying to buy wholesale deals, which count on closing on time, with whatever agreed upon prices and things of that nature were already in place. And a lot of times what we're running into, and like I said, no attack on Do Hard Money, it's the hard money lenders a lot of times, just like you talk about the 18-year-old girl and people who didn't have necessarily they haven't been flipping properties for 5-10 years like I have. So they're not able to, be capable of making a decision quick and hitting the numbers spot on for renovation budgets, ARVs. Hard money lender like yourself comes in and saves that investor maybe from making a mistake on their part. Maybe they're capable of getting the construction done cheaper. Maybe they're not. Maybe the hard money lender is a little bit conservative and protects them from buying the property, but it blows up our wholesale deal. And now I'm stuck calling in a wire, the morning of settlement. We have the cash, so it doesn't make as much of a difference to me personally, but I know a lot of wholesalers have been left in the lurch by hard money saying at the last minute, oh, the deal is not going to work for this or that reason. It doesn't fund, a deal falls apart. Can you speak to your experience on your side of the table when some of that takes place?
Yeah, absolutely. Anytime you're dealing with a hard, tangible asset, like a home that we're funding on, we'll have a lot of people that will go out there and make offers, and we'll get a call or we'll get an email saying, hey, we're under contract, and they put you down as the lender. And we're saying, okay, well, we don't even have a loan application on this property. So we'll get calls saying, we're supposed to close Friday, it's Wednesday, and what's going on? We'll say, well, we don't know what is going on. So we'll have borrowers all the time that are out there saying, hey, we're going to do a deal, with Do Hard Money, and never call us back or put in the application. So we'll get blindsided all the time. So that's the first thing I would say is, we've got to make sure if I was a wholesaler, I would get on the horn with the lender and make sure the lender's aware of the deal, make sure the lender's got it, they've got a loan application on it. I think it's easy just to say, oh, they've got money. I do this with residential deals. If you make an offer on a property I've got, I'm going to call your lender and I'm going to ask your lender if you've been through underwriting, if you've been through auto approval, what your credit scores are, if you have any derogatories. The lender's typically going to say, I can't tell you that information. And I'm going to say, let's conference in the borrower. I'm going to say, borrower, we've got this house. I need to know some things from your lender, or we're not going to go under contract with you. I want to know what your credit scores are. I want to know if you have any derogatories, have been through underwriting. The borrower says, heck yeah, I want the house. Tell him whatever he wants to hear. And so I find those things out on the front end. So if I'm a wholesaler, and I've done wholesale deals before, I'm not a great wholesaler. I'm a rehabber. Like, that's really my thing. But I've done wholesale deals. If you're going to take an offer from a hard money lender or anybody else, get on the phone, make sure that they're on the same page, make sure they have the application, make sure they know. From my perspective, from what I do, the things that stop us from doing a deal is going to be one of three things. One, the borrower gave us incorrect information or information changed on their credit report. So although we're not credit score driven, if you have judgments, collections, those types of things, you're in the middle of a bankruptcy or, something like that, that will have an impact on me. It can attach to the property, all those different types of things. So those major things, if they told us they didn't have them and then we then found out, or if they didn't and then they came up, that will have an impact. And unfortunately, when we do a date down or something like that, that can happen, up to the closing table. Now, we're always doing those in advance, so we don't run into that problem. But when we're looking at again, it can pop up. And so that doesn't happen often, but it can. The second thing that's really going to have a cause on us not being able to do a deal is the value. So we're going to be conservative on that value. We take the three lowest comps in good condition, comparable condition as to what the house will be. We lend on the after repaired value of the property, and that's difficult to do. What is this property going to turn into? Because as a wholesaler, you may think the property's worth $300,000 if you put $100,000 into it. Well, the borrower may only be planning to put $20,000 into it. So now the house is only worth $220,000, and the numbers don't work all over again. So we send out and get two independent values of each other, and we use the lowest of those two. So that's what we do because we're typically working with brand new investors, never done a deal before. Now, our experienced investors are different guidelines, right? An experienced investor, we're not going to need, it's not going to be as stringent on that. So that's the second thing that's going to cause a deal. So, the first one is changes, the big derogatories on credit report. The second thing is going to be values. The third thing is rehab budget. What we require is that we have a licensed general contractor's budget, but we have project managers that actually work with you before and after you do a deal, that work with the contractor and the borrower, because we see it so many times. Somebody shops around, they get a really good deal on construction, but it turns out the contractor was bait and switching them and then later needs another $20,000. Borrower doesn't have it, deal goes awry, turns into a problem. So we get that all on the front end. And so we have a licensed project managers. Some of them are contractors. Some of them went to school, have degrees in project management, where they're going through that with the contractor, with the borrower before we can close. So if the borrower thought $20,000 in rehab and then it comes back $40,000 in rehab, unfortunately, we're going to have to say, sorry, we can't do this deal. And so those would be the three areas I would say you'd run into problems if you're trying to wholesale a deal and a hard money lender is doing that loan. Those are some of the challenges that you're going to be up against, let alone the first one, that we talked about is the lender may not even be aware. Their name just may have made it to the paperwork.
Yeah, definitely good. The three reasons they fall out. I wouldn't have guessed the first one, that the borrower's credit and situation would have changed. The value and the rehab budget, I'd assume that those would be mistakes made. I make mistakes with them. I've been bait and switched just this year by contractors where we thought we were getting it for $25,000 and, as I'm cutting the $39,000 in checks into that rehab project, I'm wondering what happened to that guy who gave me the $25,000. But, we kind of knew he underbid the project to begin with. But
one of the things we really do, we're working to solve these problems all the time. So this is where we offer, more of a complete package. So we're working on software that we're going to roll out that's going to have pricing for rehab estimations based upon the area, based upon if you're doing designer or economical, based upon DIY prices or hiring a contractor, where you can put in dishwasher and redo the bathroom and average cost based upon your area for materials. So that's a new software we're we're working to roll out. We're also getting access where our customers are going to have access to the multiple listing services where they can do searches and those types of things so they can get more. So we're constantly asking ourselves, what can we do to help our guys get closer on these things? Because the last thing we want to have, Dan, is you or any other, wholesaler out there say, hey, this blew up in my face. And we're saying, yeah, I'm really sorry it blew up on our face too, because we've got all the time and everything into it as well, and we're ending up not with a deal either. So it's just as, I guess the other perspective I would say from a wholesaler is it's just as horrible for the hard money lender as it is for you. I realize it puts you in a horrible situation if you're planning and you need money and the seller's moving out, and those are the worst phone calls to get. But it kind of goes back to my first comment. Successful real estate investors are great problem solvers, and it's a constant thing. I mean, if you're a new wholesaler and you've got a situation where the guy's got to get out, you may not want to accept a hard money offer. You may not want to do that. It may not be the best thing. And I am not naive enough to say one size fits all. You've got to have a tool belt. You got to know which tool to use and when to use it. And that, I think, makes a big difference.
So let's talk about it from the buyer's perspective, this newer investor, because that's usually going to be where the problem lies. They, offer something high to get the deal, and I've learned to kind of ask from them, hey, I need to see proof of funds. And if I'm not seeing 20, 30% cash on hand, I'm looking at it through your perspective, and I'm thinking that this is a higher risk situation because of that fact. They don't usually show me the credit report, but depending on the bank balance, I could tell, did they do a couple things right? Have they been conservative enough to have been able to, put $20,000, $30,000, $40,000 in the bank to then want to come in and do this loan? So the situation, we do close a few with hard money, but they're typically going to be the experienced investors who are putting 10 or even 20% down with the hard money lender, have closed deals before, tons of construction experience, et cetera. So that group there, I'd say, is like off the table. We don't need to discuss. But for the newer investor who would be more prone to making some of these mistakes and who may not have the financial resources, but is going to do a deal with you, Ryan, with Do Hard Money, where would you suggest that they, or maybe your observation of their deal flow in the pipeline? So like, is there a percentage that came from REO, MLS listed inventory? Is there a percentage of these buyers in your experience already who have closed by direct to seller marketing campaigns and that's their most successful route? Or is there a percentage that goes to wholesalers? Maybe what the breakdown of those buyers looks like, so that if someone's listening, they can focus on, one or the other type of deal pipeline now to be in a better position to close the deal out, their first flip with you, even if it's a week from now or 3 months from now.
Yeah. This is my best guess, right? Because we don't know how they're getting every single deal and, some of those types of things. I would say the majority of our people are actually working with, I'd say maybe half are working with real estate agents that bring deals. And I think that's the most difficult. Anybody that's new that wants to get a real estate, it's really easy to say, hey, I'm going to get into flipping. I'm just going to hire an agent and they're going to go find properties for me. And you're going to find pretty quickly that doesn't work very well. And so that's the biggest concern I have is most of our people are just trying to delegate their success to an agent and say, go find me properties. And I constantly am saying there are some agents that can do that, but most of them can't. And so why wouldn't the agent just do it themselves? So but I would say that most of the deals that come to us come that way. And I'd say several of those don't turn out. Either the agents overvalue the property or ignore some comparables or whatever the case is. So I think we get a lot of deals from that. I'd say we probably get less than 10% of our deals from wholesalers, where they're getting, our borrowers, I should say, are getting their deals. They're, finding a deal or wholesaling, getting them that way. I think mostly because some of the complications, some of the wholesalers don't have enough time to wait, that type of stuff. We are getting people that are doing direct to sellers. Now some of them are doing, like some mailers or some of that type of stuff. I think a lot of them are doing for rent by owners or estate sales and, going out and storing up some business. And we're constantly preaching off-market properties to our customers and saying the way you're going to have success is off-market properties, is the best way to do that. And so that's where I think you're going to find our customers are going to find the deals that are going to work the best. The fact of the matter is, if you're new, a deal, you're going to have to find a really, really good deal. Whereas if you're experienced, you could just find a good deal. Meaning, if you want us to fund your rehab and your purchase and fund, payments and that type of stuff, you have to find an even better deal than what someone else would have to find in order for us to be able to fund all of those things, because we've got some magic numbers we have to stay within. So if you're experienced, you can do a deal with a little bit tighter margin and still make money. Whereas if you're new, you're going to have a little more margin in order for us to be able to give you a type of deal you're looking for. And in doing that, you're going to have to find a better property. And I think that's one of the challenges that new people have, is they're trying to get a marginal deal to fit into us giving a loan where they're coming up with little to no money, and that just doesn't work. Now, that same deal might work for an experienced investor, and that's, a base hit for him. But if you're a newer investor and you need a lot more of that covered by a lender like us, you're going to have to get an even better deal in order for you to be able to get those things funded. Now, the good news with that is it's a bigger payday, because just because it's a better deal doesn't mean we're taking that money. You're getting a better payday, but you're going to have to get better in the front end. And it's the old adage, you've heard it 100 times, you make your money when you buy it, you realize it when you sell it, and it just holds true time and time again.
Well said. If there's one skill set that I've been lucky to have stumbled onto and then developed intentionally, it was generating off-market deals and becoming the source of deals. I talk about that a lot on my show. No matter what, line of investing you're in, I don't care if it's Warren Buffett or, Sam Zell or Dan Breslin or, you flipping a house, you better find a way to develop a source continuously of deals that you can analyze, look at, and then find opportunity to jump on a few of them. So, Ryan, I'm going to switch gears again, and I want you to answer this next question two ways. One, for the investor just getting started, and then the second way would be answering it for someone like me who's been in the business 10 or 15 years or so, and that would be one or two book recommendations that you'd make.
So one of my favorite books that I would say it'd be good for anybody, but maybe more the experienced. It's not directly a real estate book, but it's called Atlas Shrugged. Have you heard of it, Dan?
Love it.
We are kindred spirits. I actually named my son Taggart after Taggart Transcontinentals. My oldest son is named after that. But it's an amazing book. It's really about the true form of capitalism. It was written by Ayn Rand, that immigrated from Russia and saw capitalism here in the United States and how beautiful it was. And, it talks about what happens when people try and take that away. And so that's one of my all-time favorites that I think you must read. The other one that I would say, which is a little bit in the same vein, it's a Napoleon Hill. This is probably for a newer investor. Master the Key of Riches. I believe I've got the title right on that. Master the Key of Riches is also an amazing book. Napoleon Hill has just some incredible work, but Master the Key of Riches would be, so I'd say that's maybe for the newer investor.
Nice. I think that's the first Atlas Shrugged that came on here. And it was cool. I didn't really know exactly when I read it. It was a few years back, and I didn't really see or feel the impact of Atlas Shrugged until the last couple of years, as I got to a level where maybe I was, putting the kind of effort in that some of the characters in the book put in. It's unique. So yeah, if anyone hasn't checked that out, definitely circle back and check that out. So I remember reading from your bio. I don't remember if we actually talked about it. I believe you were 21 when you got into business, flipping houses and that kind of thing, or starting as an agent.
Yeah, I'm kind of like you. I kind of grew up a little bit in the business, right? My grandpa flipped properties in Southern California. He was an HVAC guy and flipped a house here or there, or bought one. He flipped some in Southern Utah. My dad was a chiropractor, and he bought plexes and paid them off. He'd buy one and he'd work on it and pay it off, or turn a 4-plex into a 6-plex. And so I kind of grew up in that. And so, yeah, I started as a real estate agent when I was 21 years old.
Cool. So if you could go back to, 21-year-old Ryan and give him the crown jewel of wisdom, what would that be?
This is going to sound strange, but what I would tell 21-year-old Ryan is to learn to enjoy the journey. there's so many ups and downs. There's ups and downs in real estate investing. There's ups and downs in life. There's ups and downs. I used to see people and say, hey, man, when I make it to that level, all my problems will go away. And I'd make it to that level and my problems wouldn't go away. They might even get a little worse. And then I'd say, okay, well, when I make it to that level, then all my problems will go away. And the reality is all my problems didn't go away. And, as creation is like innate, we want to create something. I just think the human brain or spirit, if you call it that, just wants to create. And there's just a joy and a passion in creating. The downside to that is you gotta be willing to take some risks, and you want to take calculated risks and, risks that you think are going to pay off. But it's a journey, and that journey brings growth, and some of that growth is painful, and some of that growth is excitement and happiness. But the reality, and what I would say, is learn to enjoy the journey, which is something I'm working on even today.
Nice. Well said. Ryan, do you want to share some information if listeners would like to reach out to you or check out the programs you have available? Maybe you'd want to mention some of the details of those as well.
Yeah, I'd be really happy to. So, what we've done for, all of Dan's listeners, we've got one of my books. It's on Amazon, Barnes & Noble, and that stuff. How to Get More Money Than You Can Ever Handle: A Real Estate Investor's Guide to Funding Deals. It sells for $20 or $25 or something. You can get a free electronic copy if you want one. Just go to dohardmoney.com. /REI-Diamonds-podcast. And we can get that in the show notes, I'm sure. So you're welcome to download that book. And if you have interest in us helping out and getting that first deal done, or some of our softwares or some of the things that we do, you can look us up at dohardmoney.com. Give us a call. I'd be happy to talk to you, see if there's a good fit, and go from there. But get a copy of the book. That's where I would say to start with. Read through that, and I think it will give you some insights on different ways to, make deals happen, and to get going on your journey of the first one. Again, we really are looking for guys that are willing to buckle down and make things happen, and are willing to be problem solvers and go through the bumps on the road and enjoy the journey.
Cool. Get that first deal done. Hey, Ryan, I thank you for taking your time out of the busy day to share your wisdom, insights with the REI Diamond Show listeners. I am grateful to you for being on the show.
Thanks, Dan. Really enjoyed it.
And thank you for tuning in to this episode of the REI Diamond Show. Keep an eye out for the next episode. The DeRosa Group's founder and returning REI Diamond Show guest, Matt Faircloth, shares details on a recent deal, a 198-unit apartment complex renovation. You'll discover the exact method he used for the $3 million capital raise. Easy feat, since Matt literally wrote the book on raising private capital. His book is actually called Raising Private Capital, and it's published through Bigger Pockets Publishing. You'll definitely want to catch that show. If you're interested in the pre-release of the next episode before the email goes out, please subscribe on YouTube or one of the podcasting apps, including iTunes, Google Play, or Stitcher. If you've already subscribed and are enjoying the show, I'd like to ask a favor. Could you please log in to iTunes on your laptop and give us a review? I appreciate the effort and feedback. You can reach me directly through reidiamonds.com. I am always buying houses, and I am always looking for deals in Chicago, Atlanta, Philadelphia, Miami, and Tampa. So if you have a deal, preferably one I can fix and flip, please send it over. reidiamonds.com. Also, at that site, you can check out available real estate deals I have for sale and the entire archive of the REI Diamond Show, totaling more than 117 episodes. Are you an accredited investor looking for double-digit returns by passively investing in real estate deals? You can sign up to receive short-term private mortgage investment opportunities via email by going to superchargedreturns.com. Thanks again for listening to the REI Diamond Show. Dan Breslin here, signing off.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.